Well, we'd like to welcome you today to our quarterly review and webinar for Sendero. This is being taped on Thursday, April 9th at midday. I'm providing that as a caveat here because with the pace of change, things quickly become outdated, and we may either be very prescient or completely irrelevant by the time you watch it. But it could be very binary from that standpoint. I'd like to first turn to Amory Conti, who is our Director of Research and a partner here at Sendero, just to review where things shaped up during the quarter and how they are sitting relative to what our forecast was at the end of 2025. Amory, do you want to take it from here?
Yeah, absolutely. Thanks, John. Yeah, just to put things in perspective, we started the year going back to our kind of bull bear scenario. The S&P was at 68.45, and we had put a base case of between 7,000 and 7,200, with a bear case that we had highlighted where the probability would actually be higher for 2026, closer to about the 6,000 level. But the point there is part of that base bear case was really around the tariffs, maybe some missteps in NAFTA, USMCA, immigration, and inflation stories. And within that, the events of the Middle East, even though are always kind of there, certainly were not part of that case. However, having said that, just to put things in perspective of where we are as of yesterday's close, as John's mentioned, this is going to be, I'm going to be quoting numbers as of April 8th. The S&P is only down about about 90 basis points. We did hit a low earlier in March 30th. We did not quite hit a 10% correction. We were actually down 9.8% at that point. However, the growth part of the markets, which had been underperforming in the sense relative to the overall market, if you look at the Russell 1000 growth and the NASDAQ, those actually did a correction, which is defined as a 10% or more price drop. I think just to put other things in perspective, earnings for the S&P as of today are actually up about 4.5% from where we started the year. Also, a lot of movements in the commodity space, as you can imagine. Oil up about 67% from where we were at the beginning of the year. That number could change from the time I just said that. But also gold price and Bitcoin have been pretty volatile throughout month of February, March, and even April so far. And then finally, fixed income, always a very, very important topic for us. We had forecasted a range of about 4 to 4.25 on the 10-year yield. We're actually sitting close to 4.30. And just to give you a sense, we started at 4.17 on December 31st, and yields on the 10-year actually dropped pretty close to 4%. So we've actually seen a pretty big move of over 30 basis points on the 10-year. And that kind of ties into some points that we're going to talk about, which is really what's happening on the private credit side as well, which we're monitoring very closely.
Thank you. Rodrigo Lopez, who is a partner at the firm and director of due diligence, has been much more closely following what positions have been working and what hasn't been working. So why don't you bring us a little up to date on some of the things that worked in the first quarter and some of the challenges that we faced?
Yeah, thank you, John. Well, it was a quarter where defense won. Value, energy, treasuries, and internationally, Japan was also a bright spot. Growth, mostly represented by technology. Within technology, software as a service, or SaaS, being the most painful. And in duration, to Amory's point on the moves in yield duration, especially belly and longer duration, or intermediate duration and long duration, fixed income got hurt from a total return standpoint. In U.S. equities, when we look at the S&P 500 as our index, mostly represented by the M7 or the Magnificent Seven stocks, all of those hurt. And energy, defensive names, and utilities that came into the year performing really strongly held up well. International, Japan, Japan as a bright spot. Some European equities were mixed due to the war, and fixed income, treasuries, and short duration helped buoy the portfolio. In alternative investments, hedge funds that were long and short, capitalizing on dispersion, fared well. In the days where the risk-off moves were quite aggressive, everything was down as well. So we saw pain across almost all asset classes this quarter.
Thank you. Let me turn now to two of our advisors at Sendero. We'll start with Patrick Kennery, who is Patrick. Of course, many of you have met before. Comes to us from having been a chief investment officer with a major macro investing group out on the West Coast. And has now worked with us for a number of years and actively participates in our investment discussions and our investment analysis. So, Patrick, why don't we talk about some of the big themes aside simply from just the war that has interrupted things that are impacting the investment environment right now.
Okay, thanks, John. I think the most useful way to discuss this is first just kind of go, what was the status quo ante? Because as you said, I think the potential outcomes from the war are very wide, like the range of outcomes is very wide and very unpredictable. And so sort of anchoring on where things were and what trends were before that, I think is probably the most useful way to think about it. If I have been discussing on these calls and at other times that I think the risk of inflation has been maybe overpriced and over-concerned. The concern about inflation has been maybe higher than it should be because the impact of the two main sort of policy initiatives of the Trump administration that affect it, which is tariffs and immigration, are arguably negative for inflation over time. There's the one-time price increases that you get for inflation, but it also can reduce activity. And the same kind of dynamic is true with immigration in that it may have an impact on wages, but there's at least as much of an impact on consumption from a smaller population and a smaller workforce. And those things haven't really changed in terms of what the dynamic is. And I think one indicator that is a sign that specifically the immigration changes have had an effect is, and these are numbers, it's because of the government shutdown and some other things, it's hard to track them really accurately, and there's a lot of inconsistencies. But we are seeing significant declines in the rate of inflation, even negative price changes in rent. And rent would be something that you would expect to see falling because all of the people need somewhere to live, and they're going to impact the demand for shelter, and that is showing signs of significant weakness, which is kind of confirms the thought that the changes in immigration might in fact the balance is towards lower inflation, not higher inflation because of that. So that is the sort of one thing I think to keep an eye on, and it's important because right now we're seeing crude oil prices jump a lot. And so the headline numbers for inflation are going to be significantly higher, certainly for March, probably for April, given where things are right now. Crude oil is probably the fastest moving significant element of the inflation numbers. So a 67% increase in crude oil pretty much passes straight through to gasoline prices and other energy consumption, diesel, a lot of other elements. And so that's going to hit immediately. But what's interesting, and we were talking about the bond market, is the pricing in the bond market. There are regular treasury bonds, you just earn a regular nominal interest rate, but then there's also things called TIPS, Treasury Inflation Protected Securities, and those allow you to purchase an instrument that gives you compensation for inflation on the year every year. So because those exist, you can actually look at how the market is pricing inflation by looking at the difference between the yield on the TIPS and the yield on the regular treasuries. And the market's estimate of inflation going forward, if you go into the 10-year bucket, is pretty much unchanged. So what that means is that the rise in treasury yields we've seen from the war is actually not because of inflation expectation at the long end. The short end, inflation's going to be higher as measured for the next year, next 2 years based on crude oil. But going out in time, the market is saying this is a blip. It is not a structurally higher inflation, which based on the other things I was talking about, I think is at least a reasonable estimate at this point, is that there isn't anything structurally inflationary going on right now. In order for this to be inflationary, there needs to be a monetary and fiscal response to the higher prices that essentially allows people to pay the higher prices for crude oil and then they start to flow through to everything else. At this point, it's equally plausible that it actually slows economic activity here and even more so overseas, which could flow back to both lower growth potentially and also lower inflation, or at least a contrary force against inflation. So that's point one. And then I'll be quick on the second one just because I think it's significant. And this was, again, something that was unfolding before the war started, and the war has kind of taken center stage. And that is when we talk about the stock market and estimates for the market, you're largely talking about the Mag 7. They are so large, and the stock indexes are capitalization weighted, that what happens to them has a very big impact on what happens to the industry indices, even if the other 493 stocks might not necessarily be behaving the same way. And one of the points that I've made in the past is that the companies that are doing the large investments in AI, that is growing very quickly. They're essentially doubling their investment this year versus last year, and it had gone up significantly last year versus the year before. That is a very different business model for these companies. They were all essentially monopolies who were collecting rents, economic rents, not literally rents. They were collecting monopoly profits. They had very low CapEx, and so that made them very low risk companies, and so with very predictable earnings. And so this is not a negative forecast for AI and its impacts and its economic impacts, just simply that you need to assess what valuation you put on those kinds of companies when they're doing this kind of CapEx. A company like Ford that has a massive CapEx budget has a much lower valuation than something that's a monopoly with very high margins and very low capital costs. So just something to keep an eye on going forward. That story seems to have started to filter into the market, and Thano is going to talk in more detail about this, but the sort of unmitigated optimism about AI's economic impacts for tech have started to get a bit of a reassessment. And so we've seen that in weaker performance in tech and growth relative to sort of regular industrial companies in value.
Patrick, I just want to quickly And I think the last point was very good, and we can address that a little more when we turn to discussions with Thano on specific sectors and opportunities. But let's just sort of re-examine that fixed income and duration implication a little bit more too, because one of the things that your point about inflation and inflation expectations actually being relatively muted. What we have seen, though, is really real yields, meaning the real yield that people are earning on fixed income investments has been increasing, and that's something that sort of gets blurred, I think, at times. Duration, in a sense, kind of hurt, but the scenario that you're talking about would suggest that duration is reasonably attractive at this stage as well, too.
Yes. I mean, higher real yields are that's like your real income that you get from a fixed income investment is the real part. Like that's why nominal bonds don't perform well when inflation is higher, because it's not worth as much to get a fixed income at that point. I think so. 2 points on that. If the real yields remain higher, just in general, higher real yields are a tightening, and they're not good for for assets generally. It's just more of a struggle. I think you mentioned private credit. That's another area that, it's a tightening for them as well. But if, if circumstances calm down, then yes, there's value in real yields.
Thano, let's turn to you. Thano, of course, is also a member of our advisory board, and Thano comes to us from having a long career on Wall Street, both as an analyst and then as a sector portfolio manager within a very prominent hedge fund, and so is what we would refer to as the only one amongst us who's a true stock picker at this stage, and so really very focused on which sectors and how this actually impacts the relative returns within the equity markets themselves. So, Thorno, if you want to just expand on some of your thoughts based upon what we saw this quarter and how you feel about the short-term future, at least.
Yeah, thanks, John. Actually, I want to start off with an example that dovetails in with the last point that Patrick made on AI and technology related, the sort of dispersion or the reassessment. It hasn't even started. We're already in the middle of it. The stock market is clearly thinking through exactly what AI potentially might mean for existing players and for new players. Yesterday, with the announcement of the ceasefire, we of course saw a huge rally across all the major indices. And if you look under the hood, though, what happened over the course of the day was, after the euphoria of, okay, maybe this war, we'll see, but maybe, yesterday we thought this war was over for good and oil would start flowing through, we could go back to focusing on the sort of fundamentals, if you will. And it was interesting because you saw huge rallies in stocks like Broadcom, Nvidia, and Amazon, where those themes are intact with respect to they're on the right side of the AI hyperscaler trade, either sort of receiving it or they're in a good position. On the other side of it, software names that appear to be threatened by AI, I believe yesterday Anthropic made an announcement with their Mythos model. Some of those stocks gave up all the gains and then ended up down significantly. And these are not insignificant names. I mean, Oracle, Salesforce.com, CrowdStrike, ServiceNow, Snowflake. I mean, the market is choosing which companies are going to benefit and which companies are not. This is not I'm going to go own everything in the triple Qs, for example. So I thought that was very interesting, because usually after you've had a bad tape for a while, you've had a lot of worry, kind of everything goes up no matter what. And that lasted for like 2 or 3 hours yesterday morning, and then it faded. I think that says a lot about how the rest of the year is going to look between, long only and hedge funds as they choose where to put their money in this particular space. With respect to sort of other sectors, if we don't really know what's going to happen exactly in the Persian Gulf and the Straits of Hormuz. Setting aside the geopolitical win or loss for the United States, I think companies are probably going to think about the supply chain if you're in Europe or if you're in Asia about your dependence on oil coming out of the Persian Gulf, particularly if Iran is left, and we don't know if they will be, but if they're left with some sort of tolling or some sort of veto power, out of that. At the same time, Europe and the United States relations with respect to their mutual alliances, particularly NATO, don't seem to be in a good spot right now. And whether those relations recover or not, I think we're starting to see movements geopolitically that have implications for specific sectors in the market. So if we're moving more towards a world where the United States is not guaranteeing freedom of the seas everywhere and is more focused on its own national interests, whatever it determines those to be, then other players will come in and decide to build up their defenses, restructure their supply chains, maybe do redundancy. That's very different than what we've been in for the last 30 years, where there was no threats to trade and businesses were free to pursue the lowest cost provider, no matter where that was. This is a longer term trend, but it's starting to gain, I feel, a little bit of a narrative. And places that would benefit, obviously, would be, there's always the tech that can be sort of immune to that because you want to be a forefront leader in AI. But then I think industrials really stand to benefit as well, whether they're defense related or infrastructure related or building out things for AI or for energy, for example, anything to do with redoing transport or perhaps a reindustrialization where things are coming back to the United States. I think that theme is solid and good for a while. Financials are a little bit more mixed and sensitive to sort of the economy, but broadly speaking, if you have a reindustrialization or a recapitalization or a changing in where we get oil in the world because people don't want to be dependent on an area that is controlled by, heaven forbid, Oman and Iran, that is major capital spending, and financials, of course, would benefit from that. Finally, sort of on the losing side or less interesting side, all of these things probably raise the costs of things a little bit, whether you want to call it inflation or not. Things can just get more expensive to do this. And so it feels to me like there's less money, to go into things like healthcare or consumer stocks or leisure. Not saying they're not individual names that might work that are really specific, but sort of broadly speaking, they just look a little bit less interesting to me than tech, industrials, and financials. And again, inside tech, there are winners and losers for sure.
Yeah. Okay. Thank you. That's very helpful and it's very insightful. I do think that some of those phenomena, we think of them as being U.S. opportunities, but particularly with some of the industrials and some of the defense related areas, I think have real implications globally as well too, and there will be a lot of international opportunities that are created because of that. The one thing, and it sort of relates back to the fixed income issue, is it does mean that sovereigns around the world are going to be spending more money, which means they're going to be borrowing more money, and that ultimately will have implications on the fixed income side and what those real rates look like as well too. And so those are all things that we're very focused on. I want to quickly turn to one other phenomena that manifested itself during the first quarter, and has become a little bit more of a hot button. We've referred to this in the context of private credit. And just a little bit of history. Post the great financial crisis in 2008, 2009, regulators really tried to get a lot of the direct lending that was being done by banks off banks' balance sheets and into what has been a growing industry called private credit. And much of this is very similar to sort of bank loan type things. And this was first done primarily in what we call private credit funds, which were only available to qualified investors and a very restricted investment group without a lot of liquidity. Late in the sort of 2019, 2020 era, we started to see a lot of what were called business development corporations coming to the market, and then interval funds, which is a form of a mutual fund that was really providing a lot broader access to investors to be able to invest in private credit. We always recognize that there's a challenge with credit, and that tends to be a mismatch between what the liquidity of the underlying markets in credit look like and what investors may demand. And that is what we're really facing at this juncture, is a lot of this credit was used to fund private equity investments that were made when real rates were zero or negative. And those investments are not nearly as robust at this stage now that we have a long-term yield in the 4.5 range for risk-free investments, and a higher real yield in those instruments. And as a result, that area has become somewhat more challenged. Now, there are a couple of other factors that affect this too, is many of these issues don't trade. And so the marking and the mark-to-markets that exist have not been terribly robust from that standpoint. And the challenge is, now that there is significantly higher redemptions and desire for redemptions from these funds by a lot of the quote quarterly liquidity investors, the providers of these funds can't meet these redemptions, and so they're restricting what access is available to people's capital. That just has the effect of causing more people to get in line. And while the credits that underlie them may actually be very solid, the liquidity isn't. And as a result, people will find that there will be significant marks and significant markdowns in that area. This is always sort of the challenge that happens with credit, and what we refer to as the liquidity crisis. That liquidity crisis then feeds into a restriction in credit. And credit, of course, is really important to the economy because that's a part of what funds growth from that standpoint. And that's what also can cause, changes in monetary policy as well, to a degree, is to try and loosen up some of that. But that's usually not until there's been a negative impact on the economy. So this is an area we're watching very closely. But if credit spreads widen, that tends to have a negative impact throughout markets. And so it is one of those factors that as we move into the second quarter, we're paying a lot of attention to. If you have questions, we're glad to answer them. We hope that this discussion has been valuable to us. Our goal is always to try and seek to have robust and diversified portfolios that, in fact, we try to find ways to take advantage of opportunities like this as well, too. So at that, again, I'll thank all of our guests today, and we look forward to engaging in any conversations and answering any questions that any of you may have. Thank you.